So what group of people would you like to emulate? And then we'll ask Wes about the top 3 financial habits the happiest retirees have in common. But which group of people would you like to emulate?
So there's HROBs and there's UROBs, and that acronym, well, hopefully we'll get some traction. But actually, I wanted to name this book Happiest Retiree on the Block. And the publisher just didn't like the title, and we went back and forth forever, and they kind of they won the battle. But I did get to keep HROB, and throughout the book, HROB, we introduced the first chapter to the quintessential HROB, Happiest Retiree on the Block. They've got this piece of the financial equation nailed, and then they've got the rest of this life equation, whether it's family, faith, giving, social, all of these health, all these habits that they have done over the course of their lifetime. And they've, through my research, self-selected, hey, by my research, I can kind of tell, like, this is what I call the top 2 highest quintiles in happiness. And that's who I want to be like one day. And how do you get those? And probably a long way from actually being, quote, retired. I still want to emulate those habits. And I want to just not do all the things that the UROBs do, which are the unhappiest retirees on the block.
So how do you become like the HROB? Was it HROB?
Yeah, HROB, Happy Retiree on Block. So HROBs, they first of all, they nail the financial part. And I know that you guys talk a lot about this piece of the equation, and there's no perfect formula for this, but there's a couple really important checkpoints. And I find that happy retirees need to get to at least, so first of all, there's this amazing relationship between money and happiness, and more money in the early stages of accumulating and earning actually does buy a pretty large chunk of new happiness. So new money equals new happiness, and happiness levels rise. And then at a certain point, it starts to new money into the equation starts buying you less and less new happiness. So this concept of diminishing marginal happiness. So we get a plateau effect. So we get this early stages, more money saved. Maybe that means it's more cushion, more peace of mind, higher levels of happiness. And we get to kind of a plateau, but we want to at least get to that inflection point. And the first inflection point is at least, now this may sound like not a lot of money to some people, and it might sound like an insurmountable amount of liquid retirement savings for some people. So it's just really all about the perspective.
What's the magic number?
From my research, the drum roll number is it's $500,000. That's the median, not the mean amount. The median amount. So that's the inflection point between the unhappy group and the happy group. Now, more is certainly better. It doesn't hurt, but that's the first piece of the equation. The second piece of the equation is either a mortgage already paid off or being able to be paid off in the next 5 years. So that's a huge piece of the equation. So as years to pay off mortgage goes down, happiness levels actually go up. And that's one of the most interesting things I've found about happy retirees is not having a mortgage is so powerful psychologically that it literally leads to higher levels of happiness. And then the third piece of the equation, kind of the money essential, is to have.
This is a good point you bring up. Is there a diminishing marginal value after? So 5 years after a paid off mortgage, they are less happy about it, more happy about it, because financially speaking, rather than paying off a mortgage at 2%, financially, you can make a case it's better spent saved or doing something for you. But I've seen
exactly, and that's what. Yeah, no, and that's that you can't. It's hard to dispute that because the numbers don't lie. You're right. If you're making 10 to 15% in your investments, and your mortgage rate's 2.5%, then why would you pay off the mortgage early? You're giving up some opportunity costs. However, there seems to be a very powerful psychological benefit to being able to pay off the mortgage. And very often, and this is maybe another part of it, is we actually do make better financial decisions when we are feeling confident and comfortable when it comes to our overall finances. So maybe there's some of that. And I talk about trying to get some reason around this data in the book, but the data, but I also try to just continue to go back to the data. And the data to me shows that as years to pay off mortgage comes down, happiness levels go up. If you're a retiree and you're within 5 years of paying off the mortgage, you are 4 times more likely to land in that happy camp.
Wow. So we'll talk more about happy retirees when we return with Wes Moss, author of the book, What the Happiest Retirees Know. And Wes has been so generous to give 3 free copies to the first 3 of you who schedule and keep your no obligation review. So call us now, 888-988-JOSH, 888-988-5674.
The preceding program was sponsored by the Jelensky Advisory Group.
Any awards, rankings, or recognition by unaffiliated third parties or publications, including 5-Star Wealth Manager, Advisory of the Year finalist by Senior Market Advisor, and top of the $1 Million Roundtable, are in no way indicative of the advisor's future performance or any individual client's investment success. No award, ranking, or recognition should be construed as a current or past endorsement of Josh Jelensky or Wealth Quarterback LLC. Information regarding specific awards, rankings, or recognitions is available on the Wealth Quarterback website at www.jelensky.org. All investment strategies have the potential for profit or loss. Investment strategies such as asset allocation, diversification, or rebalancing do not assure or guarantee better performance and cannot eliminate the risk of investment losses. There are no guarantees that a portfolio employing these or any other strategy will outperform a portfolio that does not engage in such strategies. This broadcast should not be construed by any client or prospective client as a solicitation to effect or attempt to effect transactions in securities or the rendering of personalized investment advice. Due to various factors, including changing market conditions, the information discussed in this broadcast may no longer be reflective of current positions or recommendations. While information presented is believed to be factual and up to date, Josh Jelensky and Wealth Quarterback do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. The tax and estate planning information discussed is general in nature, is provided for informational purposes only, and should not be construed as legal or tax advice. Listeners should consult an attorney or tax professional regarding their specific legal or tax situation. Advisory services offered through Wealth Quarterback